Stop scrolling. If Washington tells you it has a housing plan in 2026, here's the first thing you should ask. Are they trying to make homes cheaper, or are they trying to make debt look cheaper? Because America's housing crisis is no longer just a market story. It's a power story. It's a legitimacy story. And it's a generational fracture that gets wider every time leaders confuse affordability with a lower monthly payment. After Christmas, Trump's team is expected to gather at Mar-a-Lago to shape what's being teased as a major housing affordability plan, with talk of treating the situation like a national emergency. That sounds dramatic. It should. The country is living through the slow-motion version of an emergency already. But here's the catch. Declaring an emergency doesn't magically create housing. It creates momentum. It creates headlines. It creates a justification for action. The real question is what kind of action? And in Washington, the fastest action is almost never building. The fastest action is finance. So before you celebrate the words affordability plan, you need to understand the oldest trick in modern housing politics. When leaders can't deliver lower prices, they try to engineer the payment. It feels like relief because the numbers on your screen look better. But the shortage doesn't change. The competition doesn't change. The sellers don't suddenly become generous. In a tight market, that payment relief often gets absorbed by higher prices. That's why the most dangerous housing policy is the one that looks compassionate on paper but quietly strengthens the market's ability to stay expensive. Let's slow down and make this plain. If you stretch a mortgage from 30 years to 50 years, you can reduce a monthly payment. That's true, but you haven't added a single home. You haven't added a single unit of supply. You've simply expanded the amount of debt that a household can carry for the same payment. Now imagine millions of households are suddenly able to qualify for larger loans because terms get longer or rates drop a bit. What happens next in a market where inventory is scarce? The market responds the way markets always respond. Prices rise until the new buying power is neutralized. That's not cynicism, that's basic mechanics. So if the 2026 plan leans heavily on ultra-long mortgages, rate portability, or any scheme built to unlock movement without unlocking supply, it's not solving affordability. It's preserving prices while changing the optics. And yes, the optics matter. Politics is optics, but you can't eat optics. You can't raise a family inside optics. You can't retire on optics. The public is angry because the lived reality is simple. Rent is high. Home prices are high. Insurance is high. Taxes feel heavier. Wages rise slower than the cost of the basics. People are told the economy is strong while their future feels smaller. Housing is where that contradiction becomes undeniable. That's why this issue is now political dynamite, and why so many leaders are tempted to offer the kind of help that protects the system rather than fixes it. Here's the uncomfortable truth most segments won't say out loud. America's housing system is built to protect homeowners, not in a conspiratorial way, in a democratic way. Homeowners vote, homeowners donate, homeowners show up at zoning meetings, homeowners call their city council, homeowners treat their home as their biggest asset. They don't want it to fall, and that creates a policy trap. Young people want prices to come down. Existing owners want prices to hold. Politicians want both groups to believe they're being helped. So the compromise becomes predictable. Don't lower the price, change the loan. That's how you end up with the phrase affordability being used to describe policies that don't reduce costs. They only rearrange them. Now watch how the media frames the debate. You'll hear talk about a magic number for mortgage rates, 5.5%. 6%, a rate that supposedly unlocks the market and brings life back to housing. That language tells you what the real goal is. It's not affordability, it's liquidity. They want transactions, they want mobility, they want listings. They want the housing market to move again because a frozen housing market is bad for economic sentiment and bad for political narratives. But here's the twist. You can restore transactions without restoring affordability. You can get more deals done at the same high price level. You can reopen the market while the next generation still can't enter it. And then you can call it a win because the charts look better. That's why you should judge this plan by one metric only. Does it increase the number of homes that can be built where people actually work and live at a pace that matches demand? If the answer is no, then the plan is a messaging strategy wearing the costume of reform. Let's talk about the policies that are likely to be on the table and what they really mean. First, the finance-heavy options. Rate portability sounds like a gift. You bought at 3%. You move, and you keep something close to that rate. It sounds like freedom. But in the real mortgage ecosystem, loans aren't just personal agreements. They are part of a massive machine. They're packaged, they're sold, they're hedged. They're priced on assumptions about collateral and behavior. If you try to carry the rate across homes, you change the risk profile. You raise hard questions about how banks secure the asset and how investors price it. Even if a limited version of portability gets designed, ask who benefits most. The people who already have low-rate mortgages, the insiders. That might increase listings at the margin, but it also risks cementing a two-tier housing system. Those who carry golden rates and those who don't. Now, the ultra-long mortgage idea. A 50-year mortgage is not a housing policy. It's a debt policy. It may reduce the monthly payment enough for a buyer to qualify, but it increases the total time the buyer is locked into the burden. It also increases the risk that a household spends a lifetime paying for an asset whose price was inflated by everyone else's subsidized qualification. In plain English, it can turn the American dream into a longer sentence. And here's the brutal part. It can protect the market's price level. Sellers keep their equity. Owners keep their wealth effect. Politicians avoid a price correction that scares incumbents. The system stays stable. The next generation carries more leverage. That's a trade. It may be a politically rational trade, but it's not an affordability victory. It's a distribution decision. Now, the supply-side options. This is where real affordability lives, and also where real political pain lives. Everyone can say, build more. That's easy. The hard part is making it possible to build more. Because the binding constraints in housing aren't just land. They're approvals, they're lawsuits, they're infrastructure, they're labor, they're local power. Zoning is local. Permits are local. Community veto is local. And local resistance is not a sideshow. It is the main act. Every time leaders promise a big supply push without explaining how they'll overcome local choke points, you should hear a quiet alarm. This is why federal land is often floated as a solution. It sounds like a way around local restrictions. Just use land the federal government controls. But land is not housing. Land needs roads, water, sewer, power, schools, hospitals. And if the land is far from jobs, the affordable housing becomes expensive in another currency: time, commutes, childcare logistics, gas, wear and tear, stress. If the land is near jobs, local resistance tends to be fierce. The closer you get to opportunity, the harder it is to add supply. So federal land can help, but only if it is paired with infrastructure and a realistic plan to integrate communities rather than dump units in distant areas and declare success. Modular and factory-built housing is another tool that deserves more attention. It can reduce costs by improving productivity. It can shorten timelines. It can lower waste. But scaling modular requires standardization, financing acceptance, and consistent building rules. It requires an industrial strategy. It requires a decision to treat housing not as a boutique local product, but as a system America needs to produce at scale. That kind of thinking is rare in housing policy, but it's exactly what would move the needle. Now let's talk about the emergency declaration itself. An emergency label can accelerate coordination. It can create political cover to cut through bureaucracy. It can focus agencies and budgets. It can also create legal fights and federal-local backlash because housing governance is shared. If Washington tries to bulldoze local authority, it risks a courtroom war that stalls progress and turns the plan into a political spectacle. So the emergency framing becomes a test of seriousness. Is it being used to coordinate supply and infrastructure, or is it being used to sell quick finance fixes under a dramatic banner? Now, here's the part that rarely gets said clearly. Housing is not just a cost problem. It's a credibility problem. When young adults are told they're living in the best economy in decades, but they can't buy a starter home, the story collapses. When people are told inflation is easing, but their rent keeps climbing, trust erodes. Housing is a national scoreboard, and right now, millions of people see a scoreboard that tells them the system doesn't work for them. That is why every affordability plan is also a political legitimacy plan. So what would a real plan look like if it were designed to change the math instead of the optics? It would treat supply as the core, not the garnish. It would align federal money with housing outcomes. If a region wants big infrastructure dollars, transit dollars, growth dollars, it should show measurable progress on permits, starts, and completions. Not just promises, outcomes. It would invest in enabling infrastructure, because you can't add meaningful density without upgrading the systems that support it. Water, sewer, grid capacity, transit, roads, schools. It would modernize building through scale, encouraging modular manufacturing, training pipelines for skilled labor, and financing systems that reward lower-cost construction rather than only higher-priced assets. It would be careful with demand subsidies. Broad buyer assistance in a tight market often becomes a gift to sellers. If support is given, it should be targeted and paired with supply expansion so it doesn't inflate prices. And it would confront the homeowner-renter conflict honestly, because there is no painless solution here. If you want homes to be truly affordable, you need more homes. And if you add enough homes in constrained metros, you change the scarcity premium that has been driving prices. That can mean slower price growth. It can mean flat prices. In some places, it can mean price declines. And that is exactly why politics prefers the payment illusion. It's safer to promise a mortgage product than to promise a market correction. But here's where the 2026 plan could be different if it's serious. The plan could be a two-track strategy that does not confuse the tracks. Track 1 is transaction thaw. If rates ease and mobility improves, that can restore movement. That helps people who need to move for jobs, family, or life changes. That's not nothing. Market movement matters. But Track 2 must be the real mission. Building enough supply so that the market stops treating shelter as a luxury asset. If Track 1 happens without Track 2, you can get a hotter market at high prices. That is the nightmare outcome for first-time buyers. So as this plan emerges, listen for the tell. If the public messaging is dominated by mortgage terms, portability, and the idea that the Fed will fix affordability, then you are watching a plan designed for optics and asset stability. If the messaging is dominated by permits, timelines, infrastructure capacity, zoning output, and measurable building targets, then you may be watching a plan designed to change the shortage. And there's one more tell. Who does the plan help first? If the first beneficiaries are people who already have homes and low-rate loans, the plan may be an incumbent rescue dressed as reform. If the first beneficiaries are renters and first-time buyers through real supply expansion, the plan may be the beginning of a true affordability era. Now let's be fair. This is not easy. America's housing mess is the result of decades of choices, a system that encourages local veto power, a tax code that rewards ownership, a culture that equates neighborhood change with threat, a financing system that treats rising prices as stability. You cannot unwind this overnight, but you can stop making it worse. And that's the standard the 2026 plan should be judged by. Does it stop widening the gap between those who own and those who don't? Does it stop turning housing into a generational lottery? Does it stop pretending that a longer loan is the same thing as a cheaper home? Because if we normalize 50-year mortgages, we are not solving an affordability crisis. We are admitting defeat and asking the next generation to finance our refusal to build. That may keep the system politically calm. It will not keep society stable. A country that cannot house its young adults cannot sustain its economic dynamism. It cannot sustain family formation. It cannot sustain labor mobility. It cannot sustain trust. And that's why this is not a niche policy debate. It's a national direction debate. No noise, no spin, just analysis. So here's the question I want you to answer in the comments, because it cuts through every talking point and every headline. Should Washington prioritize making monthly payments look smaller right now, even if prices stay high and debt lasts longer? Or should Washington prioritize policies that risk flattening or lowering home prices by building far more supply, even if that angers existing homeowners?